be okay. I think that's an okay. So hello and welcome everyone to the Scottish Mortgage Investors Forum. I'm Stuart Heggie, an investment specialist on Scottish Mortgage, and I'm joined today by one of our managers, Tom Slater, and Deputy Manager Lawrence Burns. Now, as many of you will be aware, this event was meant to take place in January. We could have done a webinar, but we took the view that whilst digital alternatives are a nice add-on, we want to see you all face-to-face if at all possible. Now, one downside of that is unfortunately James Anderson has been unavailable to attend today, and he sends his apologies. So let's move on to the format. We'll begin with a conversation between myself and the managers, and that should last about 40 minutes or so, and then that should lead ample time for questions from the audience. By way of background, we want this forum to be helpful to you and your clients when discussing Scottish Mortgage. So we're going to cover three main topics. The first is the evolution of the management team and process. It's now been a year since Lawrence joined the strategy, and we announced that James would retire at the end of April this year. The second is the current environment. In recent times, we've had concerns over rising inflation rates and interest rates, and which has had a compressing effect on the valuation of many higher growth companies, including Scottish Mortgage itself. And we now have a human crisis in the Ukraine to consider. We know these topics are going to be on your clients' minds, so we'll certainly discuss them. And the third topic will come as no surprise. It's the long-term prospects for Scottish Mortgage. Our managers are trying to identify the world's most exceptional growth companies, and when they do, to become long-term and patient owners. To bring you all up to speed, since we last saw you in person a couple of years ago, over the last 2 years, 35 new names have been added to the portfolio, and around 2/3 of those have been private companies. So we've got lots to discuss there. So let's begin with team and process. Tom, for 13 years, you've been managing the trust alongside James, and together you've constantly tried to evolve the process and really improve and try and become basically better investors. Lawrence, you've now got a year under your belt, but in fact, I know that this style of investing is not new to you. Could you tell us more about your investment background and what's led you here today?
Yeah, sure. Thanks, Stuart, and thank you as well for everybody coming and attending. It's really nice to be able to meet and see people in person for a change. I joined Baillie Gifford about 12 years ago, and I've spent most of that time really being obsessed with radical change, where it is, what it looks like, where we can find it, and investing and learning from companies that are either driving that change or are beneficiaries of that change. We'll talk about this a lot, that sort of pursuit of outliers, the pursuit of extreme returns. I think it's an investment style that firstly is a very interesting one to pursue, but I also think it's helpful because when you do get those things right, the impact can be really material for clients and shareholders. You can get a company that you're aiming for as outlier returns going up 5, 10 or 15-fold. And I think the good thing there really is that you'll always make mistakes in fund management, no matter what your investment philosophy. You'll never get everything right. But the good thing is that when you're pursuing those extreme returns, you don't have to get everything right. You can really rely on getting only a few things right to make a very good return. And that's the style of investing and the types of companies that are in SM are companies that I've sort of followed and known for many, many years. I've worked on our international strategies for the last decade, co-managing them with James Anderson, so I've worked very closely. So there's a lot of commonalities, both in the companies in SM and the companies I've been involved with before, but also commonality in terms of that high growth philosophy. But I also think it's probably right to say, even versus other things I've done, that SM is special. I think it's special in terms of the breadth of opportunity that it has, the ability to pursue extreme returns wherever they are, both geographically and being agnostic between public and private. Extreme returns are rare, so I think having that broadest possible canvas is really helpful and really matters to finding them and owning them well.
And Tom, does the change in the team lineup change your approach or outlook in any way?
No, I mean, I think as you mentioned, I've been managing the trust with James for more than a decade, and I think the approach has evolved over that period. I think we've worked to continue to refine what it is we're trying to do for people, and I guess be, as you alluded to, try to get better and better at that core task of how do you find these outlier companies, and actually more tricky, how do you hang on to them for long enough that you actually accrue that return in the portfolio? So none of that changes, and as Lawrence says, he's worked with James a long time on other strategies. So what we're trying to do from a philosophy and process has been clear for a while now, and it's just a slightly different team executing against that.
This was one of the changes in recent years has been investing in private companies, and many of our clients here today will hold Scottish Mortgage with an allocation to global equities, but will differ from them, from some of the others in the fact that it holds private names. Tom, we're now a decade on from your first investment in a private company, which at the time was Alibaba, and up until the end of last year, you've now invested in 82 private companies, 35 of which have IPO'd. How has the private company landscape changed since you first made that investment 10 years ago?
Well, I think when we started down that path, the contention was that we weren't trying to do something new, but that if we were going to continue to invest in the world's most exciting growth companies, we had to go and find them where they were, and that more and more of them were choosing to stay private. Now, if you look at the number of private companies that were valued at more than $1 billion, at the time, so this is 2012, there were just over 100. Today, I think the latest number from TechCrunch is about 2,400. So the number of companies that are staying private has really lived up to that hypothesis. There is all this growth that's happening out with the public markets. So with that, there are, I guess, the players in that space have slightly evolved. There's potentially a different set of investors, different pools of capital. But what hasn't changed is that private companies get to choose their own shareholders, and they have to have a reason that they want you to be an owner. And so there, I think, the way you behave more broadly has a direct bearing on the access that you can get and the opportunities that are available to you.
And these returns being made in private markets have not gone unnoticed by the investment community, and people are trying to find new ways of accessing private companies. SPACs would be a good example of that. Is there now a risk that there is too much money chasing too few assets?
Of course there's a risk. I think over that course of that 10 years, we've seen several waves of capital flow into looking at these opportunities. So if you go back a decade, it was the mutual funds in the US who were looking at this, but then drew back because their open-ended structures and the regulator became uncomfortable with that. You've seen SoftBank and the Vision Fund, $100 billion flow into this. More recently, there's been hedge funds. The Tiger Global, I think, is the sort of standard bearer for this. So there has been a lot of capital sloshing about for private companies for most of that past 10 years, and I don't think that's changed. But when you talk about doing 80 investments, that sounds like quite a lot, but actually, 10 years, it's 80 years. So we generally will invest in a very small fraction of what's available to us. I think as we become better known for doing these investments, there are a lot more companies approaching us directly. So I think one of the challenges is drinking from the fire hose, if you like, trying to actually sort the wheat from the chaff in that inbound. I think that companies are making a decision about their shareholders, and they will have some objective that they're optimizing for. So, why were SPACs popular for a time? Well, if your objective is to maximize your current valuation, potentially get a big chunk of capital through the door on day one, and then we'll worry about the rest later, then I think choosing to have a SPAC investor potentially makes sense. That's not the type of calculus that will lead a company to choose us as their investor. for those companies that we invest in, what they're really looking for is a long-term partner. So they've seen that, we've supported Tesla in public markets through some pretty volatile times. They've seen us own Amazon shares for almost 2 decades. And they think, right, my business is on a trajectory towards the public markets. Who do I want my partners to be through that? And I think having permanent capital, having a reputation as a long-term owner is what gets you access. It's not about being prepared to pay the highest price. And I think the challenge for people trying to get into this, you see, lots of people say, oh, we're going to start doing private companies. That's all very well. You can have good intentions, but why are the most attractive companies going to want to have you as a shareholder? I think comes back to what do you think your competitive advantage is as a manager?
I think it's fair to say that the way I tend to think about it is that in the public space, one of our edges is that reputation of being able to give long-term patient capital and be partners. And the edge there is the access you get to company CEOs like you've had with Elon Musk in the past, like we've had with Jack Ma and others. I was in Germany and asked to see Zalando, and the founder turned around and said, well, we won't give you 1 hour, we'll spend 5 hours with you. And that access is really quite powerful and helpful. But I think it becomes even greater, as you're saying, as we move into private markets, whereas it's not just the access to understand their business better and to understand their vision, but it's actually the access to invest. So I think the edge in some ways becomes even stronger in the private setting.
I think I'd add to that a willingness to be the most stupid person in the room. A lot of these people are brilliant, and if you can get some of that access, just trying to translate some of the insights that you get from that into what you're doing back in the portfolio.
I think James and Daniel Eck have both sort of said that it's uncomfortable to be the stupidest person in the room, but it's also sort of the best way to learn.
Well, on that note, we'll move on to the current environment. And there's 3 main topics that seem to have been raised by clients recently. First of all is the crisis that's unfolding in the Ukraine. Second is the impact of a sustained period of higher inflation and the impact that might have on portfolio companies. And the third is Chinese regulation. Tom, it's not an easy one, but could you start us off on the Ukraine situation?
Sure. I mean, I think the starting point for me is be careful what you ask your fund manager, because there's this constant evolution to talk about whatever the topic of the day is. Today it's the Ukraine. The week before last it was inflation. Before that it was the virus and become an epidemiologist. And that is not our domain of expertise. And so I think we ought to be very humble on that front. I think on Ukraine specifically, there's very little first-order relevance to the portfolio, exposure to Russia, etc. I think, though, the challenge that arises from it is if Putin is trying to tear up the existing world order, what does that mean for investments in China? What does that mean for the trend to globalization that we've seen over the past couple of decades? Do we have, we've probably got 2 internets at the moment. Do we stop there, or do we see a splintering further? So I think it's this sort of gradual process of trying to think through the second order impacts, whilst accepting that we live in a whole new world from the one we were dealing with last week.
Thank you. Lawrence, our clients know that our investment horizon reaches beyond short-term moves in inflation. However, inflation in the United States is currently at about 7%. And if that were to persist for, say, the next 3 to 5 years, how does that factor into your thinking?
Yeah, well, I think, as you know, and many people in the audience will know, the sort of current market narrative is that theoretically, obviously, inflation may lead to higher interest rates, and that may reduce the value of earnings that are sort of far out. And a lot of our companies have earnings that are far out because we're expecting them to grow a lot and be a lot bigger in the future, hopefully. I think you go through a period of adjustment, but I think ultimately the goal doesn't really change. The goal is how do you pursue those extreme returns and outliers. And one of the ways I tend to think about it is if we look at the past outliers, so Amazon and Tesla, I don't think that their success was a massive product of their macroeconomic environment. I think the transition to e-commerce was secular. I think the adoption to electric vehicles was secular from some of those things, and I think they would have been hugely successful companies and investments to an extent irrespective of some of those macro-environmental points. And if you look at Moderna today, I think that nothing is ever certain in the future, but as we sort of look through its questions of what else can they do in beyond COVID? And I think that answer won't really be depending on sort of inflation and interest rate. And I think that's one of the things that in some ways our time horizon and what we're aiming for of those pursuit of extreme returns makes our job a little bit easier because we're focusing on such extreme results in terms of companies. And what we're seeing from our different companies is operational performance is good and has been good even in areas where there is volatile macro. Mercado Libre is still growing revenue 60% in US dollars, and that's in Brazil and Argentina, which is a difficult environment. And we're continuing to see sort of good operational progress. And I think that gives us a lot of conviction in terms of where these companies end up on a 5 to 10 year view.
I'll probably add to that, Lawrence. I think I absolutely agree with your point about what's the dominant driver for a company's growth. I think back to 2008-9, the US economy shrank 6% in 2009. Amazon, in its core media business, so the oldest part of the business at that point, I think grew about 16% that year. So there were a couple of things at play. One was the transition from offline to online was more important than the growth or in that case shrinkage in the absolute size of retail sales. And it was also that a time of stress drove change in behavior, which has actually underpinned probably the next decade of growth. So it wasn't just about that piece. But the other point I'd add on is just about this sort of theoretical repricing of growth that I think you get this sort of first order effect where people say interest rates are going up, therefore the discount rates for future cash flows have got to go up and they're worth less today. So growth ought to underperform. Now, whether academic theory like that really drives markets is a subsidiary question which I'd leave, but I think the second order piece is actually do companies have pricing power? Because it's all very well saying those are the cash flows and discount them back, but if in an inflationary environment, companies with pricing power, you can obviously see the impact of that through the P&L, and it's not necessarily the same cash flows that you're discounting back. So, I think the market has done some of the first piece, but not necessarily thought through the implications of the inflationary environment that we've been in.
Good. Lawrence, can you provide us with an update on how the Chinese holdings are navigating the current regulatory changes?
Yeah, I think the first perspective we really have on this is that regulating technology is a global issue, not just a China issue. We see this in the EU with regulation around gig economy workers linked to some of the delivery platforms, which is actually following similar sort of regulatory moves in China. We see it in the US where DOJ will challenge Google on various practices. I think what we're seeing in China is therefore an answer to a global question that we're struggling with everywhere of how do you interact as a society with these incredibly powerful technology platforms. I think the difference in China comes from the nature of the system and the approach. And so it is an approach that is faster. So the DOJ would take several years before it even gets to trial with Google. It is an approach that is far broader simultaneously, and it is an approach that's done in a much more non-negotiable way. And I think that's something that's very difficult for the markets to digest in a difficult 12-month period as you have that material regulatory adjustment. In terms of the companies, I mean, we think about this on a global basis, not just a China basis, but it's possible it becomes as important, if not more so in China, that ultimately companies I think need to be very aware of what is their impact on the broader society. Because it's by driving those societal benefits that I think gives you a degree of protection from whether it's regulatory backlash or whether it's consumer backlash or whether it's just someone coming up with a better business model to innovate because you have these negative externalities. And so we spent a lot of time going through our individual Chinese holdings, both trying to go through the mechanics of what does the regulation mean, what does that mean for our investment scenarios on a 5 to 10 year view, and also trying to sort of grapple with, which I think is a very open question of, where are the boundaries of acceptability with profitability and scale, and how does that interact with these societal benefits? And I think for us, it's put a lot more emphasis in terms of you have to have these clear societal benefits in order to be tolerated. William Lee, the founder of NEO, when me and James visited him a number of years ago, made the comment, it's much easier to go with the grain of society than against it. And I think that's a key thing, whether you're in China or elsewhere.
I think it's. I think if I look at what some of the changes we've made in the portfolio over the past 2 or 3 years, and I mentioned this rather than having you talk about it, Lawrence, because you needn't take any of the blame for this one. But I think one of the mistakes that we've made is saying, that we think the big platform companies are going to find more growth more challenging because of some of the societal issues. And some of the regulatory issues, but the way we've implemented that in the portfolio has been to sell down the Western ones. So selling Facebook, selling Alphabet, reducing Amazon, and it's just it's interesting that, as you say, progress has been slower in addressing some of those points in the West, and the authoritarian regime in China has addressed this much more directly.
Well, having discussed the current environment, let's now move on to the third topic, which is the future. Now, we were discussing the healthcare allocation last week, and I think I'm right in saying it was in 2008 it had reached 0 within the portfolio. It's now about 22%, and your top 2 holdings, being Moderna and Illumina, are both healthcare names. So, Lawrence, the recent Moderna share price move would indicate that your view differs quite greatly from the market. What gives you such high conviction that this is a long-run opportunity and not just a one-trick pony?
Well, I think Moderna is a one-trick pony. It's just that trick isn't just COVID, which saying just COVID is something. But that one trick is a really broad and important one, and that trick is mRNA. Moderna wasn't built to solve the COVID crisis. It was built as a platform for mRNA, the ability to get the body to effectively build a protein by design. And because that technology is so powerful, it became a very quick solution and a very effective solution to the coronavirus pandemic, which I expect a number of us are sort of quite grateful for in terms of its impact. One of the reasons we're probably able to be here today. But I think one of the things that attracts us as Moderna is simply that it is something that goes far beyond the COVID vaccine. It's the breadth of their portfolio. They'll have about 40 programs currently in development. Only 10 of them are COVID related. They'll have programs around flu. They'll have programs around HIV, Zika virus, cancer, cystic fibrosis, a huge range. And I think the COVID business on its own is potentially very valuable because it's probably likely that COVID will be endemic. And particularly as you can go and combine your COVID vaccine with a flu vaccine, I think that becomes quite powerful. But I think in some ways the market, because of the near-term importance of COVID, both from a news flow and a profit sense, is really sort of not paying much attention to what else could this platform be used for. And I think that really matters because the platform is just incredibly broad. And that's something I think could drive profits and healthcare benefits for sort of the next decade potentially as they apply that mRNA technology to a larger range of healthcare issues.
Tom, there are several areas in the intersect between information technology and biology that can have a positive impact on patient outcomes. And we've got a number of portfolio companies addressing those. Could you tell us about some of them?
Yeah, sure. I mean, I think the point I'd add on Moderna, which interests me, is this idea that the next generation of software companies won't look like the previous generation. Mm-hmm. So if you're going to go look for the next Alphabet, don't go and look for somebody that's doing the same thing 20 years later. The attraction of Moderna is that it is effectively writing software code. It's just that it's not zeros and ones, it's GTs, A's and C's. It's programming. And I guess that's where some of the similarities are. But I also think, you made the point about it being out of favor, and one of the lenses I find helpful, we going through a more difficult period like the one we've seen over the past year, is challenging some of the assumptions that you've had, and I think it's a Munger quote about saying, invert, always invert. So could the converse of what we believe be true? We've thought that genomics is a particularly important technology that's going to help drive personalization of medicine for individuals. I don't think there's any evidence at all that trend is reversing. In fact, I would argue that it's accelerating, and I'd say that goes for a number of the other contentions in the portfolio, whether it's the transition from our model of IT from on-premise to the cloud, whether it's the digitization of commerce. There are all these themes running through the portfolio. You go through them one by one, and to me it seems that the case for them is strengthening. Now, your question was about the application of IT to healthcare, and I think that is exactly an example of this. That there's been this really powerful, almost universal technologies created, the ability to generate, to store, and increasingly drive insight from vast amounts of data, and that is a description of some of the big problems we face in healthcare. So, for example, we own Tempus. What they're doing, they're now testing about the genomic profile of about 20% of cancer patients in the US, and then they're using that data to suggest treatment pathways in a way that a human physician would not have the sort of encyclopedic knowledge of all the trials and the developments that are taking place, so they can assist a physician in doing that. You have something like Recursion, which is applying this technology to the process of drug discovery, so getting away from the single PhD student at the lab bench testing a single hypothesis, and instead a sort of hypothesis-free approach. So let's induce the disease state, all disease states in cells, and let's test all available compounds against them. And so what you do there is you reduce the cost of experimentation by about 90%. You reduce the cost of drugs coming to market by 90%, and it's a completely different paradigm. And I think we're still really in the early stages of the application of some of these technologies, and it's really over the next 5 to 10 years that you're going to start seeing a meaningful impact from some of that work.
And I think that's just a really important point, because so far some of the benefits of computing technology, I mean, we've seen them very strongly in the world. They've transformed areas like retail, media, advertising, giving us sort of the behemoths of Google, Amazon, Facebook, Netflix. But we're now seeing some of those underlying foundational technologies really impact other industries. I think healthcare is chief among them. In 1990, when they tried to sequence the first human genome, it took them 13 years and it cost $2.7 billion. Today, Illumina can do it in a few days for something like $300. And that's really been an output of cheaper, faster processing and data storage. And we're seeing these foundational technologies start to impact other industries and other areas that I think are more diverse than what we've had over the last 10 years, because ultimately retail, media and advertising aren't really a huge part of most economies, but we're seeing that sort of change and disruption spread out. And I think healthcare, and indeed I'd probably go wider and say biology, is sort of chief among that.
Well, I suppose on this spreading out point, much has been made over the years of Scottish Mortgage being an early holder in many of the American and Chinese companies that have grown into giants, some of which the names you've mentioned. But in fact, it's also been invested in world-class businesses that have emerged from elsewhere. So there are European names such as ASML, Ferrari, Spotify, Kering. Lawrence, we also now have a significant holding in Latin America, being Mercado Libre. And I know that you've known this company for several years. Can you outline why it's well suited to Scottish Mortgage?
Yeah, I think it's well suited because it's really trying to do not just one but two things that are really material, and they're trying to do it across a region that, it's about 700 million people almost in Latin America, a $4 trillion regional economy, and their aim is really to, well, let's say it quite clearly to us, to democratize commerce and to democratize access to financial services, and so that really sets your opportunity set. It's commerce and finance, which are two very large parts still of the economy. E-commerce penetration today in Latin America has risen, but it's still only 10%. That's around a third of where the UK is. which itself is a moving target. So there's a large opportunity still in retail. And I think what's particularly interesting is the opportunity that's really emerging for them in finance. And so that's in payments, credit, savings, insurance. And I think digital finance is an area that interests us, and it particularly interests me in emerging markets where I think the value add is even greater than it is in the West. If you've ever been into a bank in Brazil, for example, you'll probably have to put your stuff in a locker, go through a security turnstile, there'll probably be an armed guard, and when you've done all that, you'll still probably be treated more like a threat than a valued customer. The Brazilian banking system, and a number of them in Latin America, it's high annual and monthly fees, it's poor customer service, it's highest net interest margin spreads in the world. And so what Mercado Libre are doing, again, using some of that digital technology, is actually, if you can conduct those services through an app, you don't need the expensive branch network or the hundreds of thousands of employees. So not only can you offer more convenient service, but you can offer service that previously banks didn't give to large sections of the population in emerging markets because it wasn't profitable to service a small loan using a bank branch network, but it is using an app. And again, it's synergistic with the commerce business because the banks would say, well, we can't lend to these people because we don't know them and we don't have data and there isn't the appropriate credit bureaus. And Mercado Libre go, well, actually for years we've been getting e-commerce data from hundreds of millions of people and merchants, and so we do actually have some degree of financial profile, and we can use that and other innovative data to build our underwriting models and try and slowly learn how to do that. And so you end up with a very large opportunity. And again, going back to macroeconomics, Argentina and Brazil are tricky places to do business. There is high inflation, there is difficulties, but over the last 5 years, Mercado Libre have still been able to grow their revenues by 8-fold in US dollars, which again I think speaks to that secular being able to overpower sometimes some of the more difficult macroeconomic conditions.
I just pick up on that piece about payments or finance and payments more broadly, because I'd say that's one of the emergent themes in the portfolio. It spreads across the private and public space. So in public equities, we own things like Adyen, a firm which we owned as a private company and now as a public company. We own Stripe or SaltPay, both private. And I think what's becoming clearer is there's some really interesting things going on in payments, which has traditionally been rather a boring part of the e-commerce landscape. But increasingly as you're seeing data cross transactions. So what I mean by that is, if you go into a shop and buy something with your credit card, the shop doesn't know anything about you, and the credit card company doesn't know anything about what you're interested in. But I think what we're seeing in some of these payments companies is you're now seeing data across those transactions, and that's allowing these companies to create a lot more value for merchants. And so I think that's likely to be an increasingly important area. If I, as a payments company, can bring you, the merchant, more customers, then you're going to pay me more for that than you would just the service of allowing somebody to swipe their card. So just to sort of draw it out, I think you're right that it is more impactful in certain areas that don't have a modern payments infrastructure, but equally it's something that we are seeing in lots of different parts of the world coming together as a clear trend.
I mean, much like Adyen in Europe, where they're a beneficiary of behind the scenes building the financial payments infrastructure, and are really a beneficiary of some of the things you were talking about of greater complexity and fragmentation in payments, that payments is in some ways becoming even more of an important thing to solve, because you have people wanting to pay not just on Visa and MasterCard, but on Alipay, on Klarna, on cryptocurrencies. And so being able to offer payments as a service almost and support, indeed many of our holdings Adyen supports, is a really helpful place to be as we see this sort of increasing sort of complexity within the payment space.
It almost like to a change in expectations and behavior that's been accelerated by COVID. So that if you ran an offline store 3 years ago, that's possibly all you did, and or maybe you had some e-commerce competitors, but today it's likely that you've developed an online presence. You probably have your own website. You're probably selling through Facebook and Instagram and some of these other platforms. You still have the physical store, You're maybe doing delivery as well as people coming into store. So you have all these different challenges that come from the complexity of all these modes of operating, and it's what drives some of the demand. And then tying it back into what we were talking about before, are we going back to is that merchant going to go back to just doing physical store sales only? Hopefully, I think a lot of the challenges that we've experienced through COVID, go away over the coming months. But I don't think we go back to where we were 2 years ago. I think that it's a completely different operating landscape, and you see that in these companies that have been seen as prime COVID beneficiaries, which saw big spikes in their share price and then have fallen back. But actually, if you look at the underlying operating performance of these companies, it continues to be really pretty robust.
And I think some of what you've seen of the COVID is that one thing is sales of some of these companies have risen a lot, but they've also been able to inject certain scale gains that have allowed them to build out a more efficient infrastructure than they had previously. So, if you go back to the Mercado Libre one, I mean, they're now delivering products, even though they're delivering more, they're delivering it faster than ever before because they've been able to effectively bank these scale gains. And you see that a lot where it's not just the sales going up, but actually the proposition has got better over the period of the last couple of years as well.
Just picking up another theme of that's running through the portfolio, I suppose the need to decarbonise our economy is clear, and the corporate sector will have a large part to play in tackling that problem and throw up, hopefully plentiful investment opportunities. We've spoken about Tesla and the transition to electric vehicles in the past, but beyond that, where do you see portfolio companies having a meaningful impact?
So I think the energy transition is really huge in its scale. It's not often that as a civilization, as a species, we change our primary sort of mode of energy generation. And you have firstly a few things driving it. I mean, renewables, solar, wind, and now at the price where they're below fossil fuels and are continuing to decline. So that economic sense of the transition should grow. You have the imperative of climate change. I mean, you were talking about some of the second order effects earlier. I suspect energy security and energy independence, it's possible, gets more important over time. So I think there's lots of reasons that are pushing this. We've invested in a range of different companies beyond the electric vehicles of sort of Tesla and NIO. Northvolt, which is producing the batteries that's necessary for this energy transition, using sort of cheap hydroelectric power in northern Sweden. We've invested in Redwood Materials, which is founded by one of the co-founders of Tesla, J.B. Straubel. They're trying to build the recycling infrastructure for batteries to create a sort of more closed loop and efficient system. We've also invested in ChargePoint. They're trying to build out the charging infrastructure. We've invested even into electric plane vertical takeoff planes, the sort of electric flying taxis effectively in Joby and Lilium, where first it's a new mode of transport, but secondly, there is that possibility that it's one of the routes to decarbonising aviation in the very long run. So there's a range of opportunities, and we continue to see, particularly in the private space, and I think that goes back to the importance of the broad canvas, an interesting opportunity set of companies that really do need capital and need patient capital to build physical infrastructure and physical business models that can help the world make this energy transition.
And just pick up on that point, I think it comes tie that back to this: what is Scottish Mortgage particularly well placed to do? And I think it's one of those areas where we can use our scale. There are, for a number of these sort of decarbonisation companies, there is a significant build out of physical assets to do. They need significant amounts of capital, and that allied with the sort of time horizon that we have, I think is an important combination. And what I think there are a lot. Tie it into the sort of what's the environment in private company investing and the supply of capital. I think there's a lot of money going after the type of opportunities that people understand well. People know what a two-sided digital marketplace can do. What the economic model looks like. What a first-party retail online business can do. And so when you see those type of traits emerging, people pounce on it very quickly. There's a ready supply of capital. I think for some of the type of businesses you were talking about here, there's, because it's relatively new, because it's relatively capital intensive, there isn't the same competition to supply capital into those opportunities.
Yeah. I think it's deeper than that. I think it's also, there's the possibilities that a lot of the venture capital and some of the funds that you were sort of, or the flows coming into that space you were mentioning earlier, they've built their success and been built up on supplying capital very efficiently and very successfully to digital business models, where the minimum viable product in a digital space is very different from a physical space, where the time to product completion is very different. And so I think one of the areas that generally interests us is where we can see a combination of a large opportunity and growth, but also one where the playbook is more uncertain, because I think that really indicates that there's some degree of uncertainty.
Are you seeing different investors around the table with these types of businesses?
Yes, is the short answer. I mean, it's. I think that they. It depends where in the world they are, and it depends quite what they're doing. But generally, it will tend to be larger capital pools and longer term capital pools.
Well, that's great. Well, I think we're just about exactly on 20 minutes left. So we'd now like to actually see where we have questions from the audience. Now, we do have some mics, so if you could put your hand up if you have a question, and just wait until one of the mics come along so everyone can benefit from hearing from you. Are there any questions? There's one down here.
Hi, it might be a bit tricky. I'll hold one end. Perhaps if you could talk about the relationships and some of those that James obviously had, and how passing those over has been with things like academics and the like, and also whether they're actually the right relationships for the next decade, or where you're looking in that area.
Do you want to start now?
Yeah, sure. So I think first it's a good question, because I think for us some of those relationships are really important. It's a way, it's differentiated access, and it's really insightful access when you get to understand what people's vision is, and to spend that time being that dumbest person in the room and trying to understand and grapple with how they want to sort of really change things. I mean, I think SM's early meetings with Elon Musk sort of outlining that he thought there was a small but growing chance Tesla could be the world's most valuable company, 7 or 8 years ago, was just helpful in terms of trying to show the mentality with which they were approaching the problem and how they were thinking about it. I think both myself and Tom have been involved in a number of those relationships for many years. Particularly on the European side, I mentioned Zalando earlier. A company we've known since, or I've known since before they were private, before they were public. And so there's a lot of those relationships that me and Tom already have. And then there's a few as well that James has done a spectacular job building up over time, and where we're in a part of trying to transition a couple of those over. So one would be, for example, we've got a holding in a digital brand tech company, You and Mr. Jones, which now called Brand Tech Group, I believe. And the founder there, David Jones, is someone I've been getting to know over the last sort of few months and years as part of that transition. And there'll be a few other examples around that. What I would say is that going into those transitions, the amount of goodwill that's been built up is really quite helpful and impressive. And I think that is a general asset that Scottish Mortgage really does have at this point, which is, as Tom was alluding to earlier, that long history of being patient and supportive providers of capital. And that does really help and really matter. And it particularly matters in terms of reinforcing it in times when markets are volatile, and when times are difficult for companies, some of which are facing it now. I think it's a key way in which we can differentiate ourselves by being supportive of these companies, and that's the key to building these relationships in the long term. So I think you'd add around that.
Are there any other questions? There's a couple up at the back.
Thanks. Gentlemen, thanks very much for that very helpful overview. Just to your point about patient providers of capital and partnership, would that be, how should I put it, the key tenet of your response if you look at something like Moderna, which went from $19 a share to 400 and plenty, Is that, when you think about your valuation discipline, does that sort of long-term partnership override that to an extent? How do you think about those two facets of looking at the portfolio?
So what I'd say on that is, I think all investors fall on somewhere on a spectrum that, at one end you would say, you size your positions by expected future return, and that's all, and you would reweight it every day on the basis of price movements. And at the other end, you have the sort of coffee can, buy the shares, put the certificates in a coffee can, bury it in the ground, don't do anything for 10 years. And everyone's somewhere on that spectrum. We're more towards the coffee can than the day trader, but low turnover is not the same as no turnover. And so approaching that sort of valuation discipline question is, it's not just, what is the price today and, what's that as a multiple of earnings, but it's how has the addressable opportunity changed, and how has the likelihood of success changed. So if you do that on the specifics of Moderna, I think there's a couple of components to the valuation. There's one piece is the COVID franchise, and then the other piece is what that means for this pipeline of all these other opportunities. And I think a lot of the volatility in the share price of Moderna has been driven by this assessment of what are the cash flows from the COVID franchise. And actually, that seems to drive the ups and downs of the stock price in the short run. And our view has been more about the opportunity. So the likelihood of success. We think this is a platform technology. So having had success in this area, it meaningfully increases the odds of success in some of the other pieces. And then also the ability to do a lot more of that a lot more quickly, because you have the cash flows coming in from the COVID franchise. And so the market has sort of vacillated in its assessment of the COVID piece. We haven't really tried to second guess that. I don't think we've got a strong view that I guess today we have a strong view that the COVID franchise is worth a lot more than the market is assessing. But the valuation insight has been much more about what this tail piece, because I think that the whole pharma industry is set up around saying, you've got these three assets. This is our best estimate of the market. This is our best estimate of pricing. This is our best estimate of market share. That's the discounted value of these assets. I think what that sector is finding really difficult to deal with is, right, we've got 50 assets all at different stages, and it's how do you somehow do a risk-weighted net present value? And I think that's the challenge that people are struggling with.
Perhaps I could broaden it out, because it's an important question. I mean, firstly, relationships are valuable assets that we should and do take seriously, but also what we're looking for, we're looking for those outliers that companies can go up 5 and 10-fold. So we're less interested in spot multiples. I don't think they tell you much about that, but we're very interested in, does this company have the ability to be worth a multiple of its current value into the future? And there have been cases where there are companies where we have very good relationships, where we still think that they're great companies, but we've started to struggle a little bit with that question. And so you'll have seen that in the reductions of Amazon, where 1.6, 1.8 trillion, we were sort of going, what do we think the odds are of it being a $5 or $10 trillion company? We found that harder, despite all the admiration we have for the company, and particularly for Jeff Bezos. And you've also seen that with Tesla reductions. And so far, actually, the lesson is that we might have been a bit too quick with those Tesla reductions. But again, it was driven by us looking at, can you make the sort of returns that we want to make for Scottish mortgage shareholders? And when the answer is that we start to struggle, you do at some point see the reductions reflect that.
Thank you. Could you talk a little bit about your private companies? You mentioned A2 over the last 10 years, 8 a year. You probably turned down hundreds, thousands. Could you tell us a little bit more about the research process, decision process, given the multiple geographies, given the multiple sectors from pharma to electric vehicles, and perhaps a little bit about the engagement about with these private companies once you have invested. Thank you.
Yeah, should I start on that? So I think if you think about the evolution over the past 10 years of the way we've approached this, the starting point was very much our heritage in public companies. And so whether it was through the networks that we had in public company management teams that led us to potential opportunities, utilizing some of that research capability in public markets. And so, so for example, we invested in Grail, which is the business that's looking to identify cancer through doing blood draws on patients. And the reason that we came to that is through our investment in Illumina and the knowledge of the management team, and that took us to that potential investment. And I think that remains a really important piece, actually, being able to look across both worlds, because for most investors, the world is strongly divided between private and public, and there are relatively few people that move between the two. And then I think over the past decade, we, Baillie Gifford, have put significant resource into a dedicated private companies team, so who are both dealing with some of that inbound flow, but also a lot more going out and finding new ideas for themselves, building out that network of connections into the venture capital industry, which is a really important source of ideas, because like any industry, there's a real spectrum from those that are just seeking to shift assets at the highest possible price to those who really care about the future of the businesses that they've invested in and are looking for those long-term partners. But the least scalable bit, and you hint at this in your question, is actually managing those relationships, that private companies expect a lot more from you as an investor. And so there's a limit to how many one investor can manage of those relationships. And that's where having the combination of private and public is really valuable, because some of the private companies team lead those relationships, Lawrence and I lead some of those relationships, some of our other public market investors lead those relationships. So you get that scalability without having to have the core team do everything there. But I think again, what are we trying to do with the private company investors? It's to find some of those exceptional large businesses of the future. So it is you can filter out quite a lot of the inbound if with just that heuristic. It's companies like ByteDance, like Stripe, like SpaceX, where you have there's a clear understanding at the outset that the addressable market is just very, very large.
Are there any other questions? Oh, yes.
There's 2 or 3 down here at the front.
Yeah.
What are you most concerned you might miss out on in the next decade by sort of stripping things out in your filtering?
That's a big question. I guess it comes back to this. What are we trying to do? And it is find those companies that we think have the potential to be very large. We're not small cap investors. We're not startup investors. So I think it's the ones where you think actually that the trajectory is towards something that is ultimately a very large market. And I think to do that, I think you've got to be open-minded to that can come from all sorts of places. So some of the best clues, will come from actually just being out in the world meeting people. There's no point sitting behind a desk in Edinburgh thinking this stuff is all going to come to you. You've got to be out meeting companies. So I think the world reopening is really quite important from that point of view. But also that those companies tend to come in clusters, whether that's geographic or because of the market, etc., that you're focusing on. So it's making sure that you have some of those connections. We touched a bit on relationships, some of those academic relationships that bring some of those things through as well. So it's not an answer on the specific what are we worried about. I think it's that you've got to be constantly open-minded. That I think it was Mark Andreessen actually that was of Andreessen Horowitz that was talking about this really recently. He was talking about the idea of the idea event horizon for investors, and so the concept was, yes, we all know that experience is really important in this industry and the pattern recognition that goes with that. But he was talking about at what point should you quit as an investor, and his argument was that it's when when new ideas start to seem outrageous to you. So it's I know Bitcoin or non-fungible tokens. Well, that's ridiculous. That'll never work. When you start to have that attitude to new ideas, that was his assessment of when the point had reached that you should give up this game.
We had another question down at the front. Maybe just shout.
I'm sure.
Here it comes.
I'm sure I read in the past a comment that we're going to have free energy one day associated with Scottish Mortgage. Is my memory? My memory is faulty. But what is your? Could you expand on all the ideas that you're looking at on the energy transition and potentially different energy?
Do you want to start?
Yeah. I think that sort of goes back to almost what Tom was alluding to before, that I think one of the ways to make sure we don't miss certain things is to be open to the radical and the things that don't seem plausible. And part of that around sort of the potential for energy to get to the point where it's free, I think it was almost just, it was a way of drawing out, look, if you follow some of the patterns of solar and wind, where they're basically following 85% decline in solar energy over the last 10 years and it's continuing, where do you end up and what does that mean for society? And I think that's what we're really trying to get through with that and to push ourselves. So on the one hand, you're investing in energy transition to help enable that, but on the other hand, you're also going, well, how does the world look if energy is a lot cheaper? What does that change? Because that leads to a very different world. Energy has traditionally been a constraint on human activity. If it becomes abundant at some point in the future, what does that mean for companies where their edge might be around energy efficiency? What does that mean for new things that you can do? And I think that's part of, again, the challenge of making sure we don't miss out on things, is to push us and to think about, where do some of these long-term trends take us and sort of work back from there. And that's the conversation we've had as well with some of our public companies of saying, look, if energy was free or near free, how would that affect your business? Just as a way to try and understand how these things and second-order effects might ripple through. Is there anything you'd add around that?
I think it's the sort of long-run argument. If you look at it through history, as strong periods of growth or society, periods where you've seen real economic progress, it's been around our ability to capture more energy and utilize more energy. And I guess the mindset in recent decades has been much more around efficiency and this idea that we can't, that there isn't more energy for us to utilize. But as Lauren says, the cost decline trajectory in some of these solar sources and others, and also the nature of the cost structure, which is that it's all upfront capex and zero marginal cost. Could it be the case that not that you just displace existing carbon-based energy with these newer forms of energy, but effectively you get to the point of abundance with very low incremental cost and the ability to harness a much greater amount of energy and the type of progress that might enable. Mm-hmm. So it's an extreme version of it, but I think some of the contentions behind it are very much in line with our thinking in these areas.
And I think just finally to add, the other thing I think as well is that for that pursuit of outliers and to try and make sure we don't miss the next big thing, which is always a risk, is to make sure we're also not just thinking about the most likely scenarios, but the full spectrum, the right tails. Even if it's a 10-15% chance, we really want to entertain it and try and explore it, because if that 10-15% chance is a 10-fold or 20-fold return, it still matters mathematically. And so it's to make sure we concentrate almost more on the right tail cases than we almost do sometimes the base cases.
Another question in the middle here.
Thank you. Are there any areas of the market where you think there's irrational exuberance? Perhaps investors are too early on the S-curve. I've read in the FT a few weeks ago that genomics might be one of those areas, but what do you think is the next 3D printing or... Yep.
I think that's quite difficult for a couple of reasons. One is that when you're investing in some of these areas where there is lots of potential and quite radical change, not all of them are going to work, and so you've got to start with that premise that you're going to get some of these wrong. So there might be enthusiasm there, and it might be rightly placed or it might be wrongly placed, and you just can't know in advance. And so I think it's being open to that is really important. I think the second piece of it would be timing these things is almost impossible. So the idea that you can invest in the sort of knee of the S curve, I think you've got to. One of the things that we found really useful about investing in private companies is that you can build a position over time through subsequent funding rounds and find the companies that are really gaining traction and invest behind that contention. So you don't have to go all in at the start. And then the final piece on this would be that whilst there are themes that emerge in the portfolio, we're not thematic investors. We don't start with a contention, we like electric cars, let's go invest in Tesla. Instead, I would argue that it's because of Musk and Tesla that we're at the point that we are today with the growth of electric vehicles. And I think with genomics, the price of genomic sequencing would not be where it is today without Jay Flatley and the influence of Illumina. So it's the ability of these really influential companies to create the market that's most important. So I think there are areas that get a lot of attention, but they're not necessarily particularly investable. Bitcoin and cryptocurrency would be an example of that, where there's an awful lot of media coverage, but actually in terms of large investable businesses, it's still relatively early. But again, it probably is tied into the previous question about sort of ideas, not being closed-minded to some of these potential opportunities, or worrying that you might get there a bit too soon.
I think it's fair to say on the time horizon one, it's both a luxury and an advantage, because if you need to guess the year there's an inflection point, that is very difficult. So if you take electric vehicles, you don't know quite when the penetration is really going to tick up or hit an inflection point. But if you have the luxury of a long-term time horizon, you can go, well, I don't know exactly when, but when it happens, it will be meaningful. And looking at those long-term trends in battery costs, you go, well, and the further out I look, the more likely it becomes. And so I think there's an element of using time horizon to the advantage. It's much more difficult if you need to have something come to fruition in the next 18 months, because getting that to that precision is pretty hard.
I think, maybe pick up that one through a specific example, because I think it's really interesting. So we invest in a company called Zipline. And this is a drone delivery business, and we invested in it in a private round maybe three years ago, let's say, and then we increased it in a subsequent round last year. And this technology is coming down in cost and increasing in reliability. So it started out in medical applications. Because say the cost of a blood delivery in a blue light ambulance is very expensive, and you can compete with that, maybe on day one, but you can't compete with the UPS driver of low value packages. But you can see this trajectory of cost decline. You can see the sort of regulatory process grinding forward. So we haven't quite reached the point where any such company has got permission from the Federal Aviation Authority to conduct autonomous out-of-line-of-sight flight, but you can see the pathway to that happening. So as the cost comes down and the regulatory pathway ticks through, at some point, barring disasters or societal backlash or whatever it is, you're going to see an inflection in the number of deliveries that come via drones. Because it's cheaper, it's a much better service. You can schedule it down to the minute, not a 48-hour window. When will that come? I don't know. But I think if you look at these sort of well-established trajectories, it's going to come at some point. And so you don't want to get there after the fact. But predicting when it is, we just don't know.
That's great. Well, we are now over time, and I believe that lunch is now ready. So Tom, Lawrence, myself, and Claire Shaw, our other investment specialist, will be there over lunch if there are any more questions. So all it leaves for me to say is thank you very much for coming along today. Thank you.